I want to tell you about my friend Jamie. Jamie is not a finance person. She is not a Wall Street trader. She does not have a wealthy family or a trust fund or any of the advantages people assume you need to build wealth. She is a 27-year-old graphic designer who was living paycheck to paycheck, had about $1,100 in her savings account, and felt genuinely embarrassed every time someone brought up investing at a dinner party because she had never done it and did not know where to start. One Tuesday evening after work, and she remembers this very specifically, it was a Tuesday, she sat down at her kitchen table, opened her laptop, and transferred $500 into a brokerage account she had been meaning to open for almost 2 years. She bought one thing, a simple total market index fund, set up a $200 monthly automatic transfer, closed the laptop, made a cup of tea, and went to bed. That was 6 years ago. I am going to show you exactly what happened to Jamie's $500 year by year, number by number, and I promise you, by the end of this video, Tuesday evenings at kitchen tables are going to feel a lot more important than they did before. Here is the thing about investing that nobody really talks about honestly. The reason most people never start is not a money problem. It is a perception problem. We have been taught by movies, by social media, by the general vibe of financial media, that investing is something that happens on trading floors with 6 monitors and men in suits yelling into phones. We think you need tens of thousands of dollars before the stock market even notices you exist. We think that $500 is not serious money, that showing up with $500 is like showing up to a car dealership with bus fare. That is completely wrong, and the math proves it in a way that is almost embarrassing once you see it. The stock market does not care about your starting amount. It cares about one thing, and one thing only: how long you stay. And the single most expensive financial decision most people make is not a bad investment or a stock that tanks. It is waiting. It is the years spent convincing themselves they will start when they have more, when the timing is better, when life settles down. Life does not settle down, and the market does not wait for you to feel ready. Jamie was not ready. She was nervous. She did not fully understand what she was buying. She just knew that doing nothing was costing her something she could not see yet. So she started with $500 on a Tuesday, and everything that followed came from that one uncomfortable, imperfect decision. Before we walk through the timeline, let me give you the exact parameters so this feels real and grounded rather than theoretical. Starting investment $500. Monthly contribution $200. That is $6.67 per day. Less than a large coffee and a muffin. Investment vehicle, a total market index fund, something like VT or VT Sachs, or a similar low-cost fund that owns a small piece of every publicly traded company in America. Annual return, we are using 7%, which is the inflation-adjusted historical average of the U.S. stock market over the past century. Not the best years, not cherry-picked data. The conservative, real, inflation-adjusted number. No stock picking, no day trading, no timing the market, no watching CNBC, no panic selling when the market drops, just consistent, boring, automated investing in a broadly diversified fund, which, by the way, outperforms the vast majority of professional fund managers over any 20-year period. The boring strategy wins, consistently, over time, every time. Now, let us watch what it actually does. Year 1. Jamie has been at this for 12 months. She invested her initial $500 and then $200 every single month without missing a single payment. Her total contributions, the money that actually left her bank account, are $2,900. Her account balance at the end of year 1, approximately $3,090. The market added about $190 to her money. $190. She knows it sounds small. She almost laughed the first time she saw it. But here's what she told me about year 1 that stuck with me. She said, the return was never the point. The point was that for the first time in her adult life, she had an account that existed for her future, not for rent, not for emergencies, not for impulse purchase, just for her future. And that feeling, that quiet, private, nobody knows about this feeling, was worth more than any market return. Year 1 is the test, not a financial test, a character test. The market is not going to reward you dramatically in year 1. It is watching to see if you are serious. Most people fail this test by quitting. Jamie passed it by, barely noticing. Year 3, 36 month. Jamie's total contributions are $8,300. Her account balance is approximately $9,400. The market has quietly added more than $1,000 to her money. $1,000 she did not earn at work. $1,000 that did not come from any extra hour she spent at her desk. It simply arrived because her money had been working while she was living her life. This is the year Jamie stopped thinking of investing as something she was doing and started thinking of it as something that was happening, something that had its own momentum, its own life, its own quiet ambition that was running parallel to hers. She also noticed something else in year 3 that surprised her. She stopped thinking about the money. The automatic transfer had become so habitual that it no longer registered as a sacrifice. It was just how money moved in her life now, in and a portion immediately to the future. The discipline had become invisible. And that invisibility, that effortlessness, is exactly what makes compound growth work. You have to get it out of the way of your own psychology. Year 5, 60 month. Total contributions $14,300. Account balance approximately $17,500. The market has added over $3,000 above what Jamie personally invested. $3,000 of pure return. And here's the number inside that number that matters most. At $17,000 invested at 7%, her account is now earning approximately $100 per month from returns alone. $100 per month, passively, without her doing anything. Her money has gotten a job, a quiet, invisible job that pays about half of what she contributes and growing every single month. Jamie told me that year 5 was the year she stopped worrying. Not because she had a lot of money, $17,000 is not life-changing, but because she could see the direction. She could feel the trajectory. She understood for the first time that she was not trying to reach a destination. She had built a vehicle, and the vehicle was moving, and all she had to do, the only thing required of her, was not get out of the car. Year 7. 84 month. Total contributions $20,300. Account balance approximately $27,000. The market has now contributed almost $7,000 on top of what Jamie put in, and her monthly passive return, the amount her portfolio earns without any input from her, has reached approximately $157 per month. $157 per month. Passively, almost 80% of her entire monthly contribution, generated automatically. This is the tipping point, the moment where the math begins to do nearly as much work as the person. And it happened not because Jamie did anything clever at year 7. It happened because she did nothing for 7 years. She did not touch it when the market dropped 20% in 2022. She did not celebrate when it recovered. She did not move it when a colleague told her about a hot stock. She just let it run. Year 7 is the reward for the boredom of years 1 through 6. And the reward is not the number, the reward is the shift in your relationship with money. Jamie told me she felt financially untouchable at year 7. Not rich, not even close, but untouchable, because she knew what was coming next. Year 10, 120 month. Total contributions, $29,300. Account balance, approximately $44,000. Let me say that again. Jamie put in $29,300 of her own money over 10 years. The market put in an additional $14,700. Her account has grown to $44,000. The market contributed more than 40% of everything in her account without her doing anything beyond not quitting. Her monthly passive return at this point is approximately $257, more than her entire monthly contribution. Her money is working harder than she is. And here is the psychological shift that happens at year 10 that nobody talks about. Jamie stopped thinking about investing as saving. She started thinking about it as building. There is a difference. Saving is about protection, keeping money from disappearing. Building is about creation, watching something grow into something larger than you put in. Year 10 is the year most investors cross from saving psychology to building psychology. And once you cross that line, you almost never go back. Year 15, 180 month. Total contributions $44,300. Account balance approximately $81,000. $81,000. The market has contributed $36,700, more than 80% of everything Jamie personally invested. Her account is now earning $472 per month, passively more than twice her monthly contribution, every single month. Year 15 is where the curve bends. If you have ever seen a compound growth chart, you know that for the first several years, the line is almost flat. Then it starts to tilt upward. Then it starts to rise faster. Year 15 is where most investors start to feel that rise in their actual numbers, not just in a projection chart. Jamie bought a used car at year 15. Paid cash, not from her investment account, from her regular saving. But she told me something interesting about that purchase. She said she barely thought about the money, because for the first time, the money in her brokerage account had made the money in her regular account feel like pocket change. The investments had reframed everything. Year 20. 240 months. Total contributions $59,300. Account balance approximately $142,000. $142,000. Jamie has personally invested $59,300. The market has contributed $82,700. Her money has now contributed more to her wealth than her labor. Not in theory, in the actual dollar amounts on her statement. Her monthly passive return, $828 per month, every month, without doing anything. Year 20 is the quiet crossing. There is no dramatic event, no party, no notification. But something fundamental has shifted. Jamie is in her mid-40s. She has an account with over $140,000 that is generating nearly $1,000 per month passively. And it all started with $500 on a Tuesday evening at a kitchen table. She told me that at year 20, she looked back at the person who almost did not open the account that night and felt something strange. Not pride exactly, more like relief. Relief that the tired, nervous, slightly embarrassed 27-year-old who felt like $500 was not enough had been wrong. Relief that she had started anyway. Year 25. 300 month. Total contributions $69,300. Account balance approximately $228,000. $228,000 from $500 and $200 a month. The market contributed $158,700, more than twice everything Jamie personally put in over 25 years. Her monthly passive return is $1,330 per month, every single month, from an account that began with $500. Jamie did not get lucky. She did not pick the right stock. She did not time the market. She did not have special knowledge or a financial advisor or a wealthy uncle. She opened an account. She automated a transfer. She went to bed. She repeated that for 25 years. And that is the whole story. That is the complete timeline. From $500 to $228,000. From a kitchen table on a Tuesday to a financial position most people will never reach. Not because they could, but because they waited for a moment that never came. I want to be honest with you about something before we wrap up. This video is not really about $500. It is not really about index funds or compound interest or any of the technical things we talked about today. It is about one thing, the cost of waiting. Every month Jamie waited before that Tuesday would have cost her not $200, but approximately $600 by year 25, because every dollar contributed at the beginning is worth approximately $3 by the end. She waited almost 2 years before starting. By her own calculation, that 2-year delay cost her somewhere between $40,000 and $50,000 in final account value. Not because she made a bad investment, because she made no investment. Because nothing costs you more in the long run than the decision to do nothing. The $500 question is not really about money. It is about identity. It is about deciding what kind of person you are going to be with money. The person who starts imperfectly, nervously, with too little, or the person who waits until everything is perfect and never begins. Jamie is not special. She would be the first to tell you that. She is just someone who started on a Tuesday when she did not feel ready, and everything else followed from that. So here is what I want you to do right now. Not tomorrow, not after you finish this video and scroll through something else. Right now. Open a brokerage account. Fidelity, Schwab, Vanguard, any of the major platforms. Buy a total market index fund. Put in whatever you can, even if it is less than $500. Set up the smallest automatic monthly transfer you can commit to without breaking it, and then close the app. That is it. That is the entire strategy. That is everything Jamie did. That is everything the quietly wealthy people you know are doing. Start, automate, ignore, repeat. Drop a comment below and tell me, are you a Jamie who has already started? Or are you still waiting for the Tuesday that feels right? I read every single comment, and I want to know where you are in this journey. Subscribe, because this channel exists to show you the real story of money, not the highlight reel, not the get-rich-quick version, but the actual honest math of what happens when ordinary people make one good decision and stick with it. Your Tuesday is today. Open the account.